The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It is Saturday. We are at the boat show, and we're going to be talking about money. You know, what better place to be talking about money than at the boat show? It is quite a show. If you haven't been here, you should be here. If you haven't walked through this, it's an amazing thing to see. So come on out if you haven't seen it. But while you're doing that, let's talk about money. You know, as things are going along right now, you look at what's going on, you see China, you hear about junk bonds are caving in, you hear about the price of oil, which is under $30 a barrel, you hear commodities, which have cratered and fallen down, REITs, which are doing poorly, you look at private equity, which is doing poorly, you look at hedge funds, it's doing poorly. What's going on? What's going on in this whole market? Is it a repeat of 2008? Are we coming back to that? That was a recent thing. 2007, 2008, we saw things crater in. I don't believe it's going to be there. When you hear people talking about it, you hear people saying, no, they expect that the market's going to do well this year. I believe they're really true. You know, they were saying that same thing in 2007 and 2006. 2007, they were predicting that in 2008, stocks would be up almost 20% that year. Didn't happen. Stocks went the other way. So what's different with this year? What's different? Why do people think, and why do I think, things are going to be different? I remember, and if you look at and listen to the TV or read some of the journals, you see people talking the negative side, thinking things are going to go upside down. And if you look at the month of January, things look like they were going upside down. So what's with all that? I started in the market. I started as a financial advisor. Actually, we called ourselves stockbrokers in those days, back in 1986. So I went through the market drop on October 19th, 1987. And I remember that time. I just sat and stared at my screen all day long. I couldn't do anything. It was such a fascinating thing to see the market fall, raise a little bit, fall, raise a little bit, fall, raise a little bit. And at the end of the day, the market was down 30%. During that time, there was a mutual fund wholesaler. And when you're working for a large brokerage firm, or even some of the small ones, you have mutual fund wholesalers that come through and tell you about how wonderful their mutual funds are and what you should be doing. And on the Tuesday or Wednesday following that, we had a wholesaler that came into the office and claimed, you're going to be able to walk into Nordstrom's this weekend and hear a pin drop. $1 trillion is gone from the economy. You're going to be able to walk into Nordstrom's and hear a pin drop. So I went home. I told my wife, you wouldn't believe what this guy said today. $1 trillion gone from the economy. We have to go to Nordstrom's. So we did go to Nordstrom's that weekend. We went on Saturday, and we could hardly get into the store. All I could think is somebody didn't tell these people $1 trillion was gone from the economy. But as that whole thing unfolded, I began to count the number of people that had negative things to say versus those who thought things were going to recover and come around. And when the account got to 60 negative and 1 positive, I quit counting. You know, optimism prior to October 18th has been running very high, and suddenly you had pessimism. It seems to me that we're going through a lot of the same things today. If you listen to CNBC, you heard this week one of the people that was interviewed talk about what's going on with the oil market. And he said every time in the past that the oil prices has dropped like this, it indicates that we're in a massive recession, worldwide recession. You know, and I'm reminded, Samuelson wrote a textbook for economics. Everybody took the Samuelson economics course way back when. And one of the chapters started by saying that the stock market has correctly predicted 9 of the last 5 recessions. Think about that. Correctly predicted 9 of the last 5 recessions. In other words, it's not completely a prediction at all. And the same thing is going on in the oil market. If you look, probably 90% of the time when oil has come down, it's indicated that demand is dropping off and the price is coming down. Not true this time. What's been going on, I've been talking about for the last few weeks on Fridays, that we have an oversupply. We have an oversupply of oil. We've been drilling, we've been fracking. $6 trillion has been invested in Australia, off Brazil, and in China to discover and drill for oil. $6 trillion. There's been an excess of oil production. Now Iran's coming back online. No one wants to slow down because they've got an investment to move in the oil. So we have an excess capacity. I started my career at Intalco Aluminum up in Ferndale. Alcoa bought Intalco a few years ago, and they announced a month or 2 months ago that they're closing down the pot lines, the reduction furnaces, because there's an excess of aluminum on the market. There's a 23% excess capacity of aluminum on the market. Steel. There's a 600 million metric ton overcapacity of steel on the market. That's why we're seeing things drop off. Way back in the late 90s, early 2000s, there were a lot of people talking about commodities funds. Financial advisors were saying commodities were a new asset class. You had this whole concept that commodities were a thing to invest in. And when you're doing commodities, a lot of commodities are dealt not on a physical thing where you go out and you buy a hamburger, you buy a pizza, or you buy clothes, but on futures contracts where you put down money to buy something a year from now or 2 years from now at a slight increase from today's price. That's a futures contract, a derivative. And when oil a couple years ago in the mid 2008, 2009, when oil got to $157 a barrel, over 50% of the contracts for oil were simply price speculation. When the price got to $157 a barrel, there were at least 10 ships that I know of that were floating at sea where those who owned the contracts to take that oil had no means of taking the oil, no means of taking delivery. It was simply a price speculation. And of course, you remember, the price of oil came tumbling down. But that gives, or gave, an indication that there was a demand out there. It wasn't a real demand, but who knew what the real demand was? And so China increased their steel production fourfold between the year 2000 and 2015. Aluminum plants went in. Between China and India alone, $2 trillion was spent on expanding factories. So what we find today is not that demand has fallen off. In fact, in China, in the fourth quarter, they took more oil than they've taken any other quarter. It's not that demand's fallen off. It's that there's been an oversupply. And when you have an oversupply, it means the prices will generally come down. And that's what we're seeing right now. It's not like 2007. It's not like 2008 where things dropped off. That was something that was driven in part by the subprime, but also with a very highly leveraged system, government system, private system, and corporate system. If you look, essentially what we had in 2007, 2008, we had a run, a bank panic that happened. When we were leading up to that in 2007, you had everybody expanding credit. You had a lot of credit available. Individuals were taking home equity loans to buy boats. They were taking home equity loans to do purchases of washing machines and whatever they wanted to do, to take vacations. You had companies that were expanding and taking out debt. You had the banks loaning to a great extent. And of course, you had the housing market. You had a point where you reached in the housing market where they were doing ninja loans. No income, no job, no assets. You know, Recently, we had the movie The Big Short. That talks about that whole time and what was going on. That was what was going on in 2007, 2008. And if you look at each one of the financial crises, 2007, 2008 was not unique, nor was the Great Depression. We had panics that happened in 1792 following the Revolutionary War. We had one in 1819, speculation in manufacturing and credit. In 1837, we had the first Great Depression, speculation in cotton and land. 1848 followed another depression, speculation in railroad stocks and land. 1890, we had speculation in gold and silver. 1874, we had a financial crisis which took 30 years to get over. The arguments in 1874 were the same ones we were hearing in 2008 about let business just evolve. Let the survival of the fittest survive, and those who weren't fit, let them die. And of course that did happen. And that was like having 30 years like 2008. It was not a pretty time. It ended with the formation of the Federal Reserve. Don't go away. We got more to talk about. Talk about, if it's not 2008, what are we going through and how can you take advantage of it? Stay with me. I'll be right back.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
Coming to you live from the Boat Show. It is the Boat Show music, and we are at the Boat Show. Come on down if you haven't been here. I've been talking about what's going on in today's market. It's confusing. It's confusing a lot of people. And if you listen to some of the news media, it gets even more confusing. So I'll give you my thoughts on what's going on. Adam Smith wrote a book, actually in the 60s, called The Money Game, in which he talked about what was going on in the 60s, and I believe we have that going on today. He wrote about a market he called the kids market. If you look at the average mutual fund manager today, over half of the mutual fund managers are under the age of 30. Half of the mutual fund managers are under the age of 30. They did not go through the Great Recession, or they were in high school, they were in college at the time the Great Recession happened. So what does that mean? If you've been around, you've probably read and heard about the Great Depression of the 1920s and 30s. Does it leave an emotional issue with you? Does it create any fear? Does it make you feel funny? No, it's non-emotional. It happened then. So if you are older, if you've gone through it and have known people who lost their job, who lost their house, who suffered through times losing money that they intended for their college kids' education, there's a very different feeling about that whole thing. If you're managing money and you've watched accounts drop 30% in value, there's a whole different feeling than if you're a kid coming into the market in the last few years to manage a mutual fund. Adam Smith wrote, and I quote, "Memory can get in the way of such a jolly market," and he was writing about the 60s, but I think we can call that the 2010, 2011, 2012, 2013, and 14. Memory can get in the way of such a jolly market. Smith created a fictional character he called the Great Winfield, who exploited kids' market by not only investing, but investing in the kids' things. And he said, "The strength of my kids is they're too young to remember anything bad. They're making so much money they feel invincible." And that's happening today. Now, you know, and I know that one day the orchestra will stop playing and the wind will rattle through the broken window panes, and the anticipation of this freeze will freeze the rest of us who are old enough to remember. I think that's part of what's going on. We have a lot of mutual fund managers and money managers that are in their late 20s that have been through a time in which the market has been roaring ahead. I went to a conference last year. I go to several conferences, and on the panels and the presentations were money managers that had been around 20, 30 years, and they were extremely, extremely negative. They could see what was going on, and they didn't understand. I didn't agree with all they said, but one thing they didn't see what was happening. They kept talking about a market that was melting up, not melting down, not like a Fukushima nuclear plant, but a market that was melting up. And they claimed it must be because the Fed was pumping money into the economy. That's part of the reason why things are going down. They didn't believe it was going to continue to go up. But you also have the kids market that's going down. You have another thing that's going on in the market today, and that's what happens when prices of oil, prices of commodities are tanking. You have Russia, for example. Russia, in order to support their government expenditures, is tapping into their reserve funds. The estimate is by the end of the year, Russia will be out of reserve funds. The Saudis are tapping into their reserve funds. You have oil-producing and commodity-producing nations that are tapping into their reserve funds. And what are the reserve funds? You know, some of those are U.S. stocks. Is it any wonder that at the beginning of the year, you suddenly have a lot of people selling stocks? It's not because the expectation is a recession. It's not because the issues are coming up, that there's a tough time, or that earnings are down. No, because they need to sell to meet their requirements, to meet their revenue needs and their expense needs. You know, if you look at China, if you look at what's going on with junk bonds, or REITs, or commodities, or gold, private equity, all those aspects are in a bear market. They really are in a bear market. Oil's in a bear market. Commodities, steel, aluminum, they're all in a bear market. There's all of those are symptoms of too much credit going back to the 1990s and the early 2000s. That's a credit problem. Most people are looking at the symptoms and not the real problem. I've talked about that a number of times, and I'll continue to talk about it. If you look at the stock market itself, if you look at the Standard & Poor's 500, and you look at the earnings, people are talking about the earnings being flat or being down. It's not really just the Standard & Poor's that's going down. You have a portion of the market that's down. Oil is down 16 or 18%. But materials are down. Those things that are related to that credit bubble bursting are down. But if you look at some of the other areas of the market, they're doing very well. And so what we have is a market where a portion of it is doing well and a portion is really doing poorly. And it's not over. If you look at the housing market, what happened with housing? We had housing coming down in 2007, 2008. It wasn't until 2010 that things leveled out and started back up. If we have such an overcapacity in oil and steel and aluminum and those other commodities, it's going to be a long time before we dig out of this. It's not going to be a short-term problem. It's not going to be over this year. And it's going to take some time before it's over with. But there's a benefit to that. There's a benefit that people usually talk about, because when oil prices come down, when commodity prices come down, it makes things cheaper for consumers. So we have that part of the market which is doing very well. And there's been, when the macroeconomists look at what's going on in the market, if they talk about we're not seeing it through the consumers. This last week you had Jim Dimon of Chase, who was interviewed on CNBC, and what he talked about was what they're seeing at Chase. They're not doing a survey. They're not doing estimates. They actually are looking at what their customers are spending their money on. And yes, their customers are saving some. Their customers are paying some debt down. But the customers are also buying big items. They're taking advantage of the fact that gas prices are down, that some of the other things that we're buying, the prices are down, and they're buying some big items. If you look at cars, we're hitting record numbers on cars. We're buying big products. They're spending on big items. They haven't been spending on those items during the Great Recession. Now we're starting to see that. We're starting to see people buy houses. You see that in the Seattle market with a supply and inventory of houses that's way, way short of what the normal is. That's where people are spending. Richard Bernstein said that we're living in a Walmart world. When other countries have an overcapacity, what do they have to do? They come out and they lower prices. Walmart, when it moves into a new market, what do? They come in, they lower the prices, and they undercut the competition to win market share. So what does that mean? If China's in an issue where they have an oversupply of steel and aluminum and all their other products, what do? They cut the price. They take and devalue their currency. That essentially gives us a cut in price. That's what's happening with China. That's what's happening with other countries. Look at Canada. Canada is a natural resource-based economy. Their currency used to sell at a premium to ours. You used to have to pay $1.10, for example, to buy a Canadian dollar. Today, $1 buys 1.5 Canadian dollars. It's a significant change, and they're not slowing down. They've got the oil sands pumping out, and they're going to continue to pump out because they've got a tremendous investment in the oil sands. What does it do for us in the United States? It means we buy things cheaper. It's an advantage to us. And I believe it's going to continue to be an advantage for us for a number of years to come. It's a strong economy, and that's why the dollar's getting stronger. If you look around and look at where we are in terms of currencies, not only are other countries devaluing against us, but our natural movement is to see the dollar increasing in strength. It's going to continue that way. That's the aspect of where we're at. And there's advantages that investors can take of that. You can look at focusing your investments on those parts of the economy which are doing well, those companies which in this economy are going to do very, very well, and shed those things, move out of those things which are going to struggle for the next few years. It's early on energy. There'll be a time, but it's early on energy. It's early on mining. It's early on a number of materials. It's better to focus on those things which are going to have a very good year this year and next year and the following year. It's a specific and a niche market to work on. That's where you need to be. That's the place to be. I heard a market strategist, and I'll come back to a market strategist at the beginning of the next segment. We're coming up to a commercial break. I'll talk about market strategy and market strategist and what's going on there after we come back from the break. We're at the Boat Show. We're coming to you live. I always wonder why people say we're coming to you live. It's better than we're coming to you dead. Anyway, I guess live or recorded, but we're coming to you live. We're ready. And if you can, check out Adams Financial Concepts and About Money. Like us on Facebook. Add us on Twitter. We're there. Check out the blogs at Adams Financial Concepts. You'll find them on the website. We have a lot to say there as well. And right after the commercial break, I'll be back. We'll talk about market strategists and what they have to say.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
All the people will sit down. Sit down, you're rocking the boat.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
And like us on Facebook. Follow us on Twitter. Check out our blogs. Adams Financial Concepts. You'll find all of that information and a lot more on the blogs that I do. You know, yesterday on the radio, my normal program is running 3 to 4 o'clock on Friday afternoons. And yesterday I talked to Mark about market strategist. And I got so excited about it. I think I'll talk about it again today. You know, Jason Zweig, who writes a column for the Wall Street Journal, wrote a book called The Devil's Financial Dictionary. And he took terms and he defines those terms a lot of times humorously, but very often very, very accurate. And one of the ones that I was reading recently that I thought was wonderful is what he calls the market strategist. It's a noun. And he defines a market strategist as a direct intellectual descendant of the ancient Roman official known as a haruspex. The haruspex was practiced in the Etruscan art of divining the future by inspecting the livers of sacrificial sheep and chickens. The typical market strategist uses methods similar to those of a haruspex, but less accurate. However, the modern market strategist has much higher social status and earns vastly greater income than a haruspex, even after adjusting for more than 2,000 years of inflation. I thought that was pretty appropriate, especially since last Wednesday, Jack Ablin was a speaker at Rotary. He's a market strategist, macroeconomist, and he talked about things from a macroeconomic standpoint. Macroeconomics is where you're looking at the economy from a mile high, and you get a general idea of what's going on. You tried to build a roadmap. You tried to build mathematical models to describe what's going on. I like mathematical models. My undergraduate degree was in math. I went to Carnegie Mellon for my graduate degree, my master's of MBA. And at Carnegie was the school that was one of the pioneers in building mathematical models. I remember Herb Simon, who got the Nobel Prize, was one of our professors, and taking his social science class, which it was I want to say denominational, but that's the wrong word. Interdisciplinary action. Interdisciplinary things, you had accounting people teaching psychology and psychologists teaching marketing and so on. But Herb Simon, an economist, taught a class on social science, essentially. And I remember the final for that class was to build a mathematical model of decision-making at the United Nations. That was the Carnegie approach, to build mathematical models. I recently had the chance to spend time with Dr. Goodfriend, who was a macroeconomist. We talked about the economy and his predictions and his mathematical models. He was here in Seattle speaking to Carnegie Mellon alums. And I had a one-on-one. We talked about, I talked about it on the radio a few months ago. But macroeconomists, they take and they develop a huge amount of data. And we have so much data that's available. And from that, they draw conclusions. And it reminded me of my first professional job. My first real professional job was in the operations research group at Pacific Gas and Electric. Now, the idea of a utility, an electrical utility, is to forecast your power consumption needs into the future, because if you build something too late, you end up with brownouts. If you build something too early, you end up paying for a huge facility that you never get recovery from. So forecasting power consumption out into the future was very important. So there was a focus on the operations research group to do that. We did moving average smoothing, we did all sorts of things, but one thing we did was linear regression. Linear regression was big at that time, and people talk about it today, talk about correlations, how assets are correlated or not correlated to one another. That comes from regression analysis. You can take it even further into canonical correlation, but I'm not teaching a math class yet. So we'll just talk about linear regression. We wanted to see what would forecast electrical power consumption. And so we took everything, we took every variable, all the data we could find, and we put it into the hopper. And one by one, we analyzed how it influenced electrical consumption. And the idea of linear regression is to develop two variables, one of which is predictive of the other. So if one goes up, the other one goes up or down, whichever you want to be predictive of. We took all these variables and we found one that was 98% accurate in predicting electrical consumption. 98%. It was fantastic. This is looking backwards. What it had come and tracking electrical consumption and tracking this variable. Tracking this variable, as it increased, electrical consumption increased. And I learned a lesson from that. I learned a lesson. Because the variable we found that was the best predictor of electrical power consumption, the best mathematically that fit the curve the very, very best, was the number of prisoners on Alcatraz. Think about that. It had nothing to do with electrical power consumption. And if it did today in Northern California, there'd be no electrical power consumption because there's no prisoners on Alcatraz. And I learned from that there has to be a causal relationship between one and the other. Just because one curve fits the other curve does not mean one is predictor of the other or one is dependent on the other. But today, with huge amounts of data and huge computers to analyze the data, that's what we say, and that's where we come. Market strategists looking at all this information and finding all sorts of correlations. And when you look at these things, you have people doing the death cross, the Hindenburg omen, you have bearish abandonment babies, you have stochastics, you have volumes, you have candlestick charts, you have all these things that have been built up where you take one or two or five variables and you put them into an equation and find that they're predictors. And always it's looking backwards and finding something that was correlated in the past and find that it fits the curve very well, and you look simply at the data. If you look at people that are momentum players in the stock market, if you look at people that are just doing momentum, and there's a lot of them today, they're looking just at price and volume. Those are the two variables they're looking at. And they're drawing conclusions from price and volume. John Train wrote a book called The Money Masters, in which he said he would give anyone $10,000. They didn't have to put up any money on their part. He would give anyone $10,000 if they could predict the price movement of a stock. He would give them the first half of the chart, and they only had to show what happened in the second half of that chart. Any stock. All you had to do was show him the last half of the chart, and you could collect $10,000. In that offer, no one was able to do it. Talking about momentum players and those people who are timing the market, Jack Bogle, who started the Vanguard Funds, is the chief owner of the Vanguard Funds. He says in his 50 years of experience, he's never known any market timer who has beaten the market over the long term. Not only that, in his 50 years, he's never known of anyone who knew anyone as a market timer who's beaten the market. You know, Eugene Fama got the Nobel Prize in 2000, or shared the Nobel Prize in 2013, when he showed that only 3% of money managers, do as well as the market when you add their fees to how they're doing. It's a very limited number of people that are able to beat the market. It's not market timers. It's people who have a fundamental approach to the market and who don't spend a lot of their time moving in and out of stocks. My philosophy has always been to look at a large number of stocks. I probably look at 40 to 50 stocks every month, and out of that I'll find 8 to 10 that I really like. And from that, I'll spend a lot of time looking at 3 or 4, and in a year, I'll only trade once or twice. That's not a bad result for where my track record is. You can check my track record on my website, and you'll find that over the long term, I have beaten the market. But it's not trying to time the market. It's trying to be in the right places at the right time in the market. And that's what it's about today. It's not going to be in index funds. It's going to be actively managed things where people can actually take advantage of what's happened. Not following market strategists and macroeconomists, not following those who are looking at the market from a 1 mile high. It's going to be the stock pickers. That's where I think things are going to be. We're going to come back after a commercial break soon. Like us on Facebook. Follow us on Twitter. Check out the blogs, Adams Financial Concepts. I think you'll find some very interesting stories there, like the Baltimore stockbroker. Like 10 is the new 4. There's some interesting things. Find out, and maybe you know, why certain areas of the economy are doing what they're doing. I'll be right back after this commercial and follow this up. We're coming to you live from the Boat Show here in Seattle.
Love, exciting and new. Come aboard. We're expecting you.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Rock the boat, don't rock the boat, baby. Rock the boat.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
We're coming to you live from the Boat Show. And I thought it got a few laughs from the people around saying we're not dead. We're live here at the Boat Show. A great time. A lot of people are having fun. You walk up and down the aisles and you see a lot of people looking at boats, looking at equipment for their boats, looking for things that are part of the boating lifestyle. Very fascinating to see. Very interesting to see. I have to say, I invited one of my competitors to be my guest on the program today. They couldn't do that because they have to go through compliance and get a compliance approval. We live in an industry which is really regulated and really controlled. A lot of things that are said have to be passed through compliance. And in a large part, I think that's really, really good. But I think in some parts, it really limits what's said and what can be done. There was a study done by Standard Chartered Bank out of the UK. They looked at the economy, and they looked at the economy in a big picture for a long term. And they found and identified certain times in the last couple centuries when the economy has grown, the world economy has grown faster than average. And they came up with the concept of a super cycle, a time in which the world has a faster growth than normal. And they identified the first super cycle, and I've talked about this any number of times, and I'll continue to talk about it probably for a number of years. I'm not locked into it. But I believe that it's still true, even if, as we go through these times today. The first super cycle started in 1870 and finished in 1913. It was 43 years long. It was driven primarily by the industrialization of the United States. We went through a crisis like we went through in 2007, 2008, 2009. We went through a crisis in 1874, and we moved from an agricultural nation to an industrialized nation. That was a crisis where we saw, probably, we didn't keep track of the records, but we saw 20% unemployment. We saw people moving from the farms into making businesses and beginning to create industry. It was a painful time for many in agriculture. 50% of the people prior to 1874 were employed on the farms. We were to see that drop off dramatically. In fact, if you look at what happened, I got the figures going back to 1850. Before that time, 1850, the country had a population of 23 million people. 11 million people were employed on the farms. Today, we produce 600 times what we produced in 1850, and we do it with just over a million people. So with essentially 10% of what we had in 1850, we produced 600 times what we produced then. A productivity of 6,000-fold. So it was in 1870 to 1913 that we got that first super cycle, seeing industrialization grow, powerful growth. A difficult time for certain parts of the world, but a very good time for industry. London at that time was the world's financial capital. That was to begin to change at that time, and the U.S. was to become the center of the financial. The second cycle began in 1945 and lasted through 1970. It was a period of 35 years, and it was a relatively benign business cycles, but it was the rebirth of Europe, the rebuilding of Europe. But it wasn't just in Europe. It was in the wealthy countries, the U.S., the U.K., and France, and Germany. The Dow went from 150 to 1,000 during that time. It was the death of the colonial system. It was Africa and Asia became independent. It was a time of the Cold War. But we also saw building of the airports, building of the interstate highway system. We saw a tremendous growth in this country as they saw growth in Europe. And we saw the independence in the rest of the world. That was the second super cycle. Standard Chartered Bank said we started a third super cycle in 2009. And it should last past 2030. It's going to be driven by the emerging nations. The projection is that by 2030, 93% of the world's middle class will live in those emerging nations. Already, if you look at China, China has a middle class that is bigger than the entire population of the U.S. And when we talk about middle class, we're talking about a fairly wide spread. It's not a limited spread. It's a fairly wide. Middle class is when people move from a subsistence level to beginning to buy. They're beginning to buy lattes. They're beginning to buy hamburgers. They're beginning to go to boat shows. They're beginning to do those kinds of things. That's the middle class. 93% of the middle class will be in the emerging nations, and they will drive the economy. And we're going through a time in which emerging nations are having a very difficult time. Emerging nations are in a bear market. Their stock markets are in a bear market. That's not uncommon from other times as well. We're getting an announcement in the building. We're coming live from the boat show. They're competing with me. It's going to be which of us is louder. Are they louder or am I louder? I don't know. So, anyway, I'll continue in just a second. Here we are. Maybe they're done with their announcement. We'll talk about this again. It's in these emerging markets, we will begin to see them go again. We'll begin to see oil prices begin to slowly increase. We'll begin to see steel and aluminum prices begin to increase. We'll begin to see commodity prices increase, and we'll begin to see those countries continue their growth pattern. And they're going to consume our products, and they're going to consume our electronics, they're going to consume our cars, they're going to consume our planes. That's going to drive the world economy. But it's also going to be a difficult time. We're seeing that now with what's going on in emerging nations. But when you look at what's happened in Russia, with Putin and what's happened. His idea that the biggest disaster of the 20th century was the destruction of the USSR. You see a potential instability and a ferociousness that we haven't seen for the last 20 years. If you look at India and Brazil, Brazil's going through a difficult time. You look at Indonesia, Russia, Turkey, the sub-Saharan Africa. We're seeing those countries grow in stature. That doesn't mean their stock markets are going to grow. That doesn't mean there aren't big risks. There will be big risks. Political and socially, that's a significant risk in the market. We're going to see politicians and bureaucrats. We went through Arab Spring and we saw the democracy going on there. But that is a limited time, and we're seeing the fallout from that. Those political and social things are going to be characteristic of what happens for the next 15 or 20 years during the super cycle. That doesn't mean growth is not going to go on. It doesn't mean that we aren't going to see a very good growth. It doesn't mean that companies in the U.S. are not going to participate in that. I would guess, my estimation is that within a few years, it won't matter where a company is domiciled. Companies will have international branches, international sales, whether they're located in Jakarta or in Tbilisi in the country of Georgia or in Lagos in Nigeria. Companies are going to have an international presence, and if they don't have an international presence, they aren't going to survive. We live in a disruptive time. That's going to continue. But I believe that it's going to be a greater danger investing in those overseas companies than it is in the U.S. companies. I've got a whole talk about that as well. But you're going to have to join me, or you're going to have to pick it up in the blogs on my website, Adams Financial Concepts. Check the blogs. Like us on Facebook. Follow us on Twitter. We've got a lot to say. You just heard a very little bit of it here at the Boat Show. And we are coming to an end. So have a great time. And if you haven't been to the Boat Show, please come to the Boat Show. Have a great time. And listen to Adams Financial Concepts and About Money Fridays from 3 until 4 on KKOL, 1300 AM on the dial. Until next Friday, have a great week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored by Adams